Now coming to chapter 4, which is on risk and return. The first component is risk. Now in a business, the businessman has to make certain forecasts. The result of these forecasts will be known in the future itself, and the future is uncertain. So there is a risk that the actual results may vary from the expected or the forecasted scenario. So risk is the possibility of adverse happening. It is a situation lying between certainty and uncertainty. So risk is possibility of adverse happening. It is a situation lying between certainty and uncertainty. This is certainty, that is 100%, and this is uncertainty, 0%. So the risk lies anywhere between these two. Risk is a situation in which future outcomes together with their associated probabilities are known. Risk is a situation in which future outcomes together with their associated probabilities are known. Now this was about risk. Coming to the next component we have is return. Return basically means receiving back. Return means receiving back. When a businessman invests his money, he expects to receive it back after some point of time. Return has several dimensions, like book value versus market return, single period versus multi-period return, ex ante expected versus ex post realized return, and security versus the portfolio return. This is dimensions of return. First is book versus market return. Single period versus multi-period return. Ex ante versus ex post return. This is expected versus ex post is realized return. Security versus portfolio return. Looking at the first component, book versus market return. Book return is normally the return on assets. Book return is the return on assets. Whereas the market return is based on the market value of assets. Based on market value of assets. Coming to the second dimension of return, that is single period versus multi-period return. Single period versus multi-period return. Returns are always related to specific time period. Are always related to certain time period. Now we have a formula for calculation of return. This is return is equal to P1 minus P0 divided by P0. Here P1 is the value after certain period of amount, value after certain period, or value after certain period, or the amount, and P0 is the value at the beginning. Value at the beginning. We can also call it as the amount invested. Amount invested. Now single period return is repayment of amount invested in lump sum along with interest. Single period is repayment of amount invested in lump sum along with interest, whereas multi-period return is recurring return. Third is ex ante versus ex post return. Ex ante versus ex post return. Ex ante, it is the hope of investor that he will realize certain percentage of return. This is the expected return by the investor. Expected return by investor. Ex post return is the actual return realized. This is the actual return realized. Fourth dimension of return is security versus the portfolio return. We have the fourth dimension is security versus portfolio return. A security return is return on particular security or a single stock. Return on particular security or single stock. For example, dividend received on a share of ABC Corporation. On share of ABC Corporation. Now, in case of portfolio return, portfolio is the pool of securities. Portfolio return is the cumulative return from all the securities in the portfolio. this is cumulative return from all the securities in the portfolio. Now, how can this portfolio return be calculated? It can simply be calculated using summing up the weighted average of returns of individual stocks. It can be calculated using summing up the weighted average of returns of individual stocks. That was about the return. Coming to the types of risks we have. Now the risk can be divided into two components. There can be a systematic risk and there can be unsystematic risk. Page number 23. The topic is types of risk. Types of risk. This total risk can be divided into two components. Total risk can be divided into two components. These are systematic risk and unsystematic risk. Systematic risk and unsystematic risk. Now, systematic risk is the risk caused by factors external to the investors. Systematic risk is the risk caused by factors external to the investors. External to the investors. And these factors can be changes in these components. Changes in economic, political, and social conditions. Now, components of systematic risk are as follows. Components of systematic risk are as follows. They can be market risk, interest rate risk, and purchasing power risk. Interest rate risk, and third is purchasing power risk. We're going to learn about these risks one by one. Taking up the first one we have is market risk. Market risk. Market risk is the phenomena of variations in expectations of investor in respect to his investment, which can be either due to changes in the return produced anticipated from his investment or that produced anticipated from the investment by other investors. Market risk is the phenomena of variations in expectations of investor, in respect of his investment. Either due to changes in return produced, or anticipated from his investment, or anticipated from his investment, or that produced, or anticipated from investment by other investors. Market risk is the reaction of investor to security returns and prices of its own and others. Market risk is the reaction of the investor to security returns and prices of its own and others. Second is interest rate risk. Interest rate risk, it refers to the uncertainty of future market values and of the size of future income caused by fluctuations in the general level of interest rates. This is the uncertainty of future market values. Uncertainty of future market values and of the size of future income caused by fluctuations in the general level of interest rates. Now, interest rates vary depending on demand and supply of money. Interest rates vary depending on demand and supply of money. Third component of systematic risk is purchasing power risk. Third is purchasing power risk. Generally, there is an imbalance between supply of and demand of goods and services. The prices may be fluctuating, leading either to inflation or deflation. Now, purchasing power risk refers to this impact of inflation or deflation on an investment. Now, it says purchasing power risk is generally there is an imbalance between supply of and demand of goods and services demand of goods and services. Their prices may be fluctuating. Their prices may be fluctuating, leading to either inflation or deflation. Inflation is general increase in the prices. And deflation is general decrease in the prices. Now, purchasing power risk refers to this impact inflation or deflation on an investment. The implication of the purchasing power risk is that investors have to provide for an allowance for the unexpected changes in prices. Now we have a formula for calculation of systematic risk. Systematic risk can be calculated. Systematic risk is equal to beta security square into variance of market. So that was about the systematic risk. Coming to the next type of risk we have is unsystematic risk. Unlike systematic risk, unsystematic risk is the risk that is specific to the company. Unsystematic risk. Unsystematic risk is a risk specific to a company. These could be like equipment failure, industrial relations problems, etc. An unsystematic risk can be calculated. Unsystematic risk is equal to total risk minus the systematic risk. This is how we can calculate the unsystematic risk. Now next topic is measures of risk, that is how can the risk be measured. Measures of risk. The following statistical techniques are used to measure risk. First is the standard deviation. Standard deviation. Second, variance. Third, coefficient of variance, which we also call it as CV in short. Skewness and probability distribution. Now we are going to learn about these in detail one by one. Taking up standard deviation at first. First is standard deviation. So how we can calculate standard deviation? Standard deviation is equal to under root variance, and variance is equal to x minus x bar square into probability. Let's take up an example to understand this. For example, we are given return and probability, and from this we have to calculate the standard deviation. Calculate standard deviation. The return and probability are as follows. Return is 30, 50, 60, 100. Probability of return of 30 is 0.2. This is 0.5. Again 0.2 and 0.1. Now here we have to calculate the standard deviation. Now let's denote return as x. Let's denote return as x. Okay. So first column we are taking as return, that is x. X is 30, 50, 60 and 100. Now is probability 0.2, 0.5, 0.2 and 0.1. In the next column what we'll do is we'll multiply the x into probability. X into probability. So this is 30 into 30, 20% of 30 is 6, 25, this is 12 and this is 10. This is x bar, that is the expected return. How much it is? 6 plus 25 plus 12 plus 10. 12 plus 10. 53. Okay. 53. This x bar is same as this we talked about here in the formula of variance. Next thing what we have to do is x minus x bar. So x we have is return and x bar we have got as 53. So x minus x bar. 30 minus 53 is minus 23. Okay. 50 minus 53 is minus 3, 60 minus 53 is 7 and 100 minus 53 is 47. In the next column what we'll do is we'll square this. X minus x bar whole square. 23 square of 23, 529. Square of 3 is 9. Square of 7 is 49. And square of 47 is 2209. 2209. In the next column we have to multiply this x minus x bar into the probability, that is 0.2, 0.5, 0.2 and 0.1. So let's calculate it. X minus x bar square into probability. 529 into 0.2. 529 into 0.2 is 105.8. 9 into 0.5 is 4.5. 49 into 0.2 is 9.8 and 2209.1 is 220.9. Let's sum it up. This will be equal to the variance plus 4.5 plus 9.8 plus 220.9, 341. and under root this is 18.46 or 18.47. So x bar or mean is 53 that we have taken from here, variance is 341 and standard deviation is under root variance, that is 18.47. So this was the first measure of risk, standard deviation. Coming to the second measure, that is variance. Now variance we have already covered. We've covered variance first actually. No issues with that. Second is variance. Now variance we've already learned, and or we can say that this is square of standard deviation. Now coming to the third measure, that is coefficient of variance. Coefficient of variation. Coefficient of variation, in short known as CV. CV is risk divided by return. Risk, standard deviation. We denote standard deviation with this symbol, and return means mean, that is x bar, which was like 53 in the previous question that we did. Now both these components we have already calculated. All you have to do is divide the standard deviation with the mean in order to calculate coefficient of variation. Coming to the fourth measure of risk we have is skewness. Now skewness tells us about the symmetry of data. The data can be positively skewed or negatively skewed. It tells us about symmetry of data. Data can be positively skewed or negatively skewed. Now, what does positive and negative skewness implies? Positive skewness implies that there is less likelihood of returns being lower than mean. This is positive skewness. It means that there is less likelihood of returns being lower than mean. This is less risky. Now, his negative skewness implies higher deviations from the mean. It implies higher deviations from the mean. The fifth and the last measure of risk is probability distribution. Fifth is probability distribution. Now you must have heard people saying that there is 30% probability of the stock going up. So probability distribution is a measure of someone's opinion about likelihood that an event will occur. Probability distribution is used to calculate expected return, that is X bar or mean. So probability distribution is measure of someone's opinion about likelihood that an event will occur. It is used to calculate expected returns. That is X bar or mean, which we have already calculated. Still we'll do an example on this. Percentage return given to us are as 40, 0 and minus 20, and the probability is 0.3, 0.5 and 0.2. So now from this we'll calculate the expected return. How do we calculate this? This is percentage return into the probability. We take this as X and this is X into probability. This is 40 into 30%, 12, 0 and this is negative of 4. So this is 12 minus 4 is 8 and we have the expected return as 8. So now this probability, it is the opinion about the likelihood that an event will occur. That is, in our case, that a return of 40% will be provided by the company. The likelihood of this return being 40% is 30. Okay, coming to the next topic is risk and return of a single asset. This is risk and return of a single asset. Now the example we did on the last page, in which we calculated the mean and standard deviation, was an example of risk and return of a single asset. Okay. Now suppose you have two investments giving you same return but different standard deviation. Which one will be chosen by you? Let's do the analysis part in it. You have two investments, investment A and investment B, and expected return from investment A is 20% and from B is also 20%, and the standard deviation from this is 8% and this is 6%. Now you have to decide which investment will be picked up by you on the basis of standard deviation. Now in this case, the return in both the cases is 20%. 20% in both cases. This is which investment will you prefer? Which investment will you prefer? Okay, return is 20% in both cases, but standard deviation in case of B Limited is less. Standard deviation in case of B Limited is less than that of A Limited. Which means that security is having higher standard deviation is more riskier. Standard deviation is you know that standard deviation is a measure of risk. Standard deviation is a measure of risk. The security having higher standard deviation, the security having higher standard deviation means more riskier security. Given return of A and B the same, security B will be selected because it has lower risk. Security B will be selected because it has lower risk. Now this was risk and return of a single asset. Coming to risk and return of two asset portfolio. Risk and return of two asset portfolio. Let's see this with an example. We given probability of 0.20, 0.50 and 0.30. There is 20%, 50% and 30%. And the return is, return on stock X is 10, 20 and 40. And on return on Y is 20, 15 and 60. Okay. And the question says proportion of investment in A is 40% and proportion of investment in B is 60%. Proportion of investment in A is 40% and proportion of investment in B is 60%. Now how will you go about solving this? You have to calculate the risk and return in this case. That is not the risk of individual securities but the risk of the portfolio containing of these two stocks X and Y. We have to calculate the overall risk of portfolio and the overall return of the portfolio. In the first step, we will calculate the expected return of both the securities as we have been calculating it till now. First is step 1 is calculation of expected return. All you have to do is multiply with the probability. So this is probability. $50.30 and return X 10, 20, 40. Expected return is 2 and this is 10 and this is 12. X bar is, this is 24 I guess. Yes. Return of Y is 20, 15 and 60. Again probability into return, expected return of Y. This was the expected return of X. This is 4, 7.5, 18. This is 29.5. This is Y bar. Okay, now since we have calculated the expected return of both the securities, let's write it down on a next piece of paper. This is expected return of security X is 24 and expected return of security Y is 29.5. Now overall expected return is return of X into weight of X plus return of Y into the weight of Y. Overall expected return is equal to expected return of X into weight of X plus expected return of Y into weight of Y. Now the proportion of investment was given as 40% in A and 60% in 40% in X and 40% in Y. Okay, this is wrong here on the last page. This is X and Y, not A and B. X and this is Y. Just make the corrections. So this is how we calculate the overall expected return. So expected return of X is 24 into weight of X is 40%, 0.40, and expected return of Y we calculated as 29.5 and multiply it with the weight of Y, that is 0.60. Now how much does it come out to be? I think it's 27.3. So the overall expected return from the portfolio, see the individual securities given expected return of 24% and 29.5%, but the overall expected return of the portfolio is 27.3%. This was about the return of two assets. Coming to risk of two asset portfolio. Risk of two asset portfolio. Now risk we mean standard deviation. Now risk will be referring to as standard deviation. So when there is a perfect positive correlation, that is correlation plus 1, then in that case standard deviation is, the formula is different, and in case the correlation is other than positive 1, the formula is different. So first of all we're going to write down the formulas and then we'll do a comprehensive solution on it. So case 1 is, risk is, this is standard deviation, that is how do we calculate the standard deviation of two asset portfolio. Case 1 is when there is perfect positive correlation. Perfect positive correlation, that is correlation is equal to plus 1, then in that case overall standard deviation is equal to standard deviation of A, that is standard deviation of first security into weight of A plus standard deviation of B into weight of B. This is similar to what we calculated in the return, that is expected return of first security into weight of first security plus expected return of second security into the weight of second security. Similarly, the standard deviation of first security into weight of first security and standard deviation of second security into the weight of second security. However, in case there is correlation other than plus 1. Coming to case 2. When there is correlation other than plus 1. So in that case the formula changes. Overall standard deviation is equal to under root standard deviation of A. I am referring to here as first security into weight of A whole square plus standard deviation of B into weight of B whole square plus twice of standard deviation of A versus B. Standard deviation of A into weight of A into standard deviation of B into weight of B and correlation AB. Let's write down what all these components are. SDA is standard deviation of A. WA means weight of A. SD of B is standard deviation of B. WB is weight of B. And RAB means correlation between A and B. Correlation between A and B. Now this weight will be given in the question. We have learned to calculate standard deviation. Now the issue remains with the calculation of correlation. So first of all, we'll learn to calculate the correlation and then we'll go ahead with using this formula. Now if you remember that formula, A plus B whole square is equal to A square plus B square plus 2AB. So similarly, we are using that formula over here. This is just for remembering. How can you actually remember it? Take this whole thing as A, okay, this as B, and this is twice of AB. This is A square plus B square plus 2AB, this thing, and into correlation AB. This is the formula for overall standard deviation. Now coming to correlation. Now correlation shows the interrelation of return between two securities. Correlation ranges between -1 to +1. Says correlation shows interrelation of return between two securities. It lies between range of -1 to +1. -1 to +1, and it can be calculated as correlation is equal to covariance to securities divided by standard deviation of A into standard deviation of B, the first security and the second security. Now you see that for calculating correlation, we need to find out what is covariance. So let's learn about the covariance. Covariance is the combined variance of two securities. Covariance. Covariance is combined variance of two securities. It is the combined risk when two securities move together. Covariance can be calculated using the following formula. Covariance is equal to RA minus RA hash RB minus RB hash into probability. This is return of A minus expected return of B into return of B minus expected return of B into the probability. So you'll understand all these calculations once we'll do a practical question on this. So let's take up a question for understanding all this. The question is given: proportion of investment in A is 30%. proportion of investment in A is 30% and proportion of investment in B is 70%. Probability given is 0.2, 0.5 and 0.3. Return of A is given as 10, 14, 20 and return of B is given as 6, 15 and 11, and you have to calculate the following components. Calculate. First is expected return of A. Second is expected return of B. Third is standard deviation of A. Fourth is standard deviation of B. Fifth is covariance of AB. Sixth is correlation AB. Seventh, overall return. And eighth, overall standard deviation. So now this question covers all the components. Starting with this, first we have to calculate is expected return of A. So how do we calculate this? What is expected return of A? Expected return of A is return of A into probability. This is summation of return of A into probability. So let's do this solution. This is probability .2, 0.5, 0.3. Return of A. Return of A is 10, 14, 20. Okay, so expected return of A is return of A into probability. So this is 2. How much it is? 7. And this is 6. So add this up. This is 15. Expected return of A is 15. Coming to return of B. Return of B is given as 6, 15 and 11. What we'll do is we'll multiply this with probability. Return of B into probability. How much is it? 1.2. This is 7.5. This is 3.3. This is expected return of B. How much? 12. 12. This is RB hash. Now we have calculated return of A, return of B. Now comes standard deviation of A. How do we calculate standard deviation? This is for A, RA minus RA hash, that is 15, RA minus RA hash whole square into the probability. This is how we calculate it. So let's calculate RA minus RA hash. RA is 10, RA hash is 5. So this is minus 5. 14 minus 15 is minus 1 and 20 minus 15 is 5. So let's calculate for B also first, and then we'll square both these components. RB minus RB. RB is 6 and this is 12 minus 6. 15 minus 12 is 3 and 11 minus 12 is minus 1. Okay. Now calculation of variance first, and then we'll underroot it in order to calculate the standard deviation. So RA minus RA hashed square into probability is the variance. So RA minus RA hash square into probability. This is what we are calculating here. RA minus RA is 5. 5 square is 25 and 25 into 0.2 is how much it is? 5. 25 into 0.2. Yes, it's 5. 1, this is 0.5, and where is it? RA minus RA hash 5. 25 into 0.3 is 7.5. This is 13. This is variance of A. Now next thing is RB minus RB hash square into probability. RB minus RB hash 6, 36, 36 into 0.2 is 7.2, I guess. 3 into 3 is 9 into 0.5 is 4.5, and 1, this is 0.3, and the total comes out to be 12. So till now we have covered till here. Next thing we need to calculate is covariance. The formula for covariance is over here: RA minus RA hash RB minus RB hash into probability. Now we have both these components, RA minus RA hash, RB minus RB hash. We just have to multiply it with the probability. So this is RA minus RA hash and this is RB minus RB hash. So RA minus RA hash into RB minus RB hash into the probability. We have to multiply these three components, this and the probability. So this is 5 into 6 into 0.2 is 6. 1 into 3 into 0.5 is minus 1.50, and this is negative of 5 into 0.3 is again minus 1.50. The total is 3. This is covariance. So now we are good to solve the entire question. So first it asked was expected return of A. This is 15. Second, it asked about the expected return of B, which is 12. Right. Third, standard deviation of A is equal to under root variance A, which is under root 13 is equal to 13 under root is 3.60. This is 3.606. Fourth is standard deviation of B is equal to under root variance of B. Variance of B was 12 and under root 12 is 3.464. This is 3.464. Fifth component it is asking is covariance of A and B. Covariance AB. We've already calculated this covariance as 3. So this is 3. Now the sixth point it is asking. Sixth is correlation AB. Correlation AB, this is equal to covariance AB divided by standard deviation of A into standard deviation of B. How much was the covariance? Covariance was 3. Covariance was 3 and standard deviation of A was 3.606, whereas the standard deviation of B was 3.464. So how much the correlation comes out to be? This is 3.606 into 3.464 memory plus 3 divided by memory recall, and this is 0.24. 0.24. Next point it is asking is overall return. We have already calculated overall return, so let's calculate it once again. Point number 7 is overall return. Overall return is return of expected return of A into weight of A plus expected return of B into weight of B. So how much was the expected return of A was 15 and weight of A was 30. It was the in the first line it was mentioned that the proportion of investment in A is 30%, that is weight is 30%, and proportion of investment in B is 70%. So the weight for B becomes 70%. Plus how much is the return for B? Return for B came out to be 12 and weight of B is 0.70. Solve this. This is 4.5 and this is 8.4. So 12.9% is the overall return. So the last component that we have to calculate is overall standard deviation. This is 8th point. Overall standard deviation. So we had two scenarios under this. First was in case the correlation is +1 and second was in case the correlation is other than +1. In this question, while calculating, the correlation came out to be 0.24. So we'll use that formula, that big one, a square plus b square plus 2ab into correlation ab. Let's write down the formula first. Overall standard deviation is equal to standard deviation of A into weight of A whole square plus standard deviation of B into weight of B whole square plus twice of standard deviation of A weight of A into standard deviation of B weight of B into correlation AB. Just put the values. Standard deviation of A is 3.606 into weight of A is 0.30 square plus standard deviation of B is 3.464 into 0.70 plus twice of 3.606 into 0.30 into 3.464 into 0.70, and this is to be multiplied by 0.24. This is the correlation. So solve this. .606 into 0.30 square of this 1.17. Let me put it in numeric plus, and this is 3.464 into 0.70 and square root of this numeric plus, and next component we have is 3.606 into 0.30. Thing, let me write down the first two components first. First was 7.05. Now this is the first component was 1.17, second was 5.88, and the next is 3.606 into 0.30. Then 3.464 into 0.70 into 0.24 into 2, 1.259. So let's take it as 1.26. 1.26. Let's add these components. 1.17 plus 5.88 plus 1.26. 8.31, and under root of 8.31 is 2.88. 8.31 is equal to 2.88. So we have calculated the overall standard deviation, which was the last Last part required in this question. Now coming to the last topic of this chapter, that is risk-return relationships. This is risk-return relationships. The first model that we have under risk-return relationship is capital asset pricing model. Capital asset pricing model, also known as CAPM in short. It states that there is an implied equilibrium relationship between risk and return for each security, and there are various assumptions of this model. It states that there is an implied equilibrium relationship between risk and return of each security. Now we have various assumptions of this model. Assumptions of CAPM model. First is investors make their decisions only on the basis of expected return and risk associated with the security. Investors make their decisions only on the basis of expected return and risk associated with the security. Second is, an individual investor cannot influence the price of a stock in the market. An individual investor cannot influence the price of a stock in the market. Third being, investors can borrow and lend funds at riskless rate of interest. Investors can borrow and lend funds at riskless rate of interest. Fourth is, assets are infinitely divisible. Assets are infinitely divisible. And the fifth point is, there are no transaction costs involved on buying and selling of stocks. There are no transaction costs involved in buying and selling stocks. And sixth is, there is no personal income tax. No personal income tax. So how do we calculate return under expected return as per CAPM. As per CAPM, expected return can be calculated using the following formula. As per CAPM, expected return is ER, expected return is equal to RF plus beta RM minus RF. ER is expected return, ER is expected return, RF is risk-free rate, RM minus RF is risk premium, and B is beta. This was about the capital asset pricing model. Coming to the next model that we have is Bauer's model of investment decision making process. This is Bauer's model of investment decision making process. Whenever there is a discrepancy between desired results and the actual results with regard to performance variable, the investment process is initiated. A discrepancy produced by information system of organization initiates a search for a solution that may result in definition of a capital expenditure project. This is whenever there is discrepancy between desired results and actual results, with regard to performance variable, the investment process is initiated. A discrepancy produced by information system of organization information system of organization initiates a search for solution that may result in definition of a capital expenditure project. Of a capital expenditure project. Now this was about the Bauer's model of investment making process. Coming to next model or theory that we have is arbitrage pricing theory. This is the last theory under this model. This is third is arbitrage pricing theory, that is APT. In arbitrage pricing theory, there are a number of industry specific and macroeconomic factors that affect the security returns. Arbitrage is nothing but the process of earning risk-free profits. Arbitrage is nothing but the process of earning risk-free profits. Risk-free profits. Now it says in arbitrage pricing theory, there are a number of industry specific and macroeconomic factors that affect the security returns. Now this theory has certain assumptions. Let's learn what these assumptions are. Assumptions of this model are: first is that it assumes that the investors have homogeneous expectations. Investors have homogeneous expectations. Second is that investors are risk averse. Investors are risk averse and utility maximizers. And third assumption under this is perfect competition prevails in the market. Perfect competition prevails in the market. And there is no transaction cost. The formula for arbitrage pricing theory is, for the calculation of expected return, we have as per APT, expected return is equal to B1 into SF1 plus B2 into SF2 plus B3 into SF3 and so on, where ER is expected return, B1 is beta 1, SF1 is sensitivity factor 1, and so on. This is B2 is beta 2, sensitivity factor 2, and beta 3 into sensitivity factor 3. I hope you enjoyed learning this chapter. The next chapter that we will be doing is cost of capital, that is chapter 5.